Okay, ladies and gentlemen, so today we're going to move to chapter 33, which deals with interest rates once again. And it covers essentially the structure of interest rates. I've warned you a couple of times already that the mode of analysis that we used thus far assumed, by and large, that the interest rate is dictated primarily by the time preference of the general public. The interest rate is a price that we have in the time market. Time market is a market in which people exchange present for future goods, and the interest rate is a price of present goods in terms of future goods. It's a number that allows us to translate the values of present goods into the values of future goods, so you'll remember this basic formula. The interest rate is a discounting factor that shows us how much future goods are more valuable or are less valuable than the present goods. So we know that the present goods, all other things being equal, will be more valuable because of the fact of positive time preference. And this formula, very simple one, shows us how much higher the interest rate, higher this discounting factor will be, and larger the difference between the present value and future value. So that's the basic definition of interest rate as a factor, as a price of time, in a sense, as a number that allows us to translate present values into future values or vice versa. And I said that we intentionally simplify things in this analysis of the time market by assuming away or ignoring other things that affect the real market interest rates that people pay in real financial transactions. And this factor today is a time to bring into the picture those other factors beyond the time preference. So we're seeing that this interest rate here, that is determined only by the price of time, only by how much people prefer present goods versus future goods, is called the pure rate of interest. The pure rate of interest means that even in the absence of risk, even in the absence of inflation, if everything else is perfect, if there is no uncertainty of any kind, this interest rate would still be charged because the time preference exists no matter what. Now, today we're going to say something about two other categories of factors that can affect and that routinely do affect the market interest rates. The first one is risk. The second one is inflation. How these two factors affect interest rates. And as a part of that, we're going to define or differentiate between nominal and real interest rate. Okay. So then in your book, there's a nice sentence that interest rate is actually a package. It's not a single number that you can discover by looking at the time. Market is a package that consists of multiple components. Only one component of this package is the pure rate of interest, or as I called it, originary or pure rate of interest. There's just one component. The second component is the risk premium. So I give you $100 of loan, and you pay me back 105. this $5 is a premium for weighting. Let's say the first component, which is contained in the pure rate of interest, is a premium for weighting, premium for sacrificing the present good for a future good. Okay. So you're going to pay me $105 in future money to compensate me for sacrificing $100 in present money. Okay, so that's the premium for weighting. Risk is also a component of interest rate that is then added up to this initial time market component, which compensates for default risk. Or risk that you're gonna default on your debt obligation, that you're not gonna pay back the loan. So the real interest rate that people will pay on the financial markets contains both of these components. They're added. Default risk. Default risk. So then with the same rate of time preference and two borrowers who have different credit histories and different likelihoods of paying back the loans, you will have two different market interest rates. Of course, we all know that. So the fact that I will pay, let's say, 11% and William will pay 8% doesn't mean that the time preference component is different in these two loans. No, it's the same. But the risk component or the risk premium is higher. If I'm a riskier borrower with a poorer credit score, then my interest rate will be higher. So German government bonds have a much lower interest rate than Greek government bonds. Why? Not because the time preference is different. Time preference component is different in both cases, but because the German government is much more likely to pay back the loans, to pay back the bonds than the Greek government. So the risk of German government defaulting on its debt obligations is very low, which is then reflected in low overall interest rates. So this pure component or time component of interest rate is fixed no matter what. All loans, all interest rates from highest to lowest in the market have the same time market component, the same pure component. What accounts for an array of different interest rates being paid by different market agents is number one, risk component. It's primary, which involves different established underlying riskiness. So I know that person A is a riskier borrower than person B. Of course. And number two, even if I don't know, there will be different costs of figuring out who is a risky borrower and who is not. So you have, in addition to default risk, you have the costs of obtaining the information about the riskiness, or loan negotiation costs. So if I'm a first-time borrower, the costs of ascertaining how reliable I am as a borrower are higher than if I had 15 years credit history and people know it was stellar credit rating, so that people can, or a very bad credit rating. So the costs of figuring out how risky I am are much higher if I am a first-time borrower than if I have a previous credit history. Good or bad, it doesn't matter. Default risk might be very high, but then the cost of negotiating loans could be very low if people already know that I'm a really deadbeat borrower. Or if I'm a person with a stellar credit rating, again, the costs of negotiating loans are low. I could be a very good and conscientious borrower, but if I'm applying for the first time for a loan, the costs of negotiating this loan could be significantly high. That also contributes to this risk component, the interest rate, the costs of negotiating the loans. That's another add-on. Add-ons like the default risk and costs of negotiating the loans. These are add-ons in addition to the pure time market component of the interest rate. You have these two that increase the interest rate. So default risk and costs of negotiating loans. And these are always positive because the information is not perfect. We know that. Information is a costly good, any kind of useful information. Okay? Any questions thus far? So when you add up these two components, the risk component and the pure market, pure time preference component, you get what is called real interest rate. Equals time market or pure rate. Let's be strict. Pure rate plus risk compensation. Risk compensation plus pure rate of interest. That's the real interest rate. Now, when it comes to risk evaluation, this is interesting because you have multiple institutions that do that. You have a credit rating agencies and banks and institutions that rate your credit worthiness as an individual borrower. So everyone, if you had, how many of you had a credit score already? Credit cards? Yeah, mine too. Okay, so I have mine too. So what does the credit score depend on? What are the criteria that they use to evaluate your credit score?
How long you've had?
How long? What else?
You pay back.
Whether you pay back regularly, whether you miss the deadline, how much you borrow. So it's better, your credit score is going to be better if you borrow a lot of money and you pay back in time. That's the best of both worlds. So you have then they have certain algorithms and certain methods of evaluating and numerically calculating your credit score. So higher the credit score, the better. So you have this all kinds of categories from excellent, extraordinary, then very good, fair, poor. And you typically have a fair or credit score or something like that when you start your career as a borrower, and then you either go up or down depending on your history of what you do and how good a borrower, how conscientious borrower you are. So then they reduce your risk. So if you have a high, go ahead.
Sorry, what did the real interest rate equal to?
Real interest rate is a pure interest rate plus risk compensation. This is the risk component that accounts for the default risk. So let's say I lend you $1,000 and 5% pure interest rate. That would be $50, and then plus, let's say, $40 as a compensation for risk, because nobody is 100% certain to pay back the loans. Let's say that $40, it's 4%. So then the real interest rate that you pay 9%, $90, 9%. Okay, so this is risk component, this is time preference component, this is principal or present money. So then the real interest rate in the market would be like a $90, which means 9% of $1,000. Whereas the risk component is 4%, 50%, 5% of $50 would be the time. Okay, so where I was before, yeah, the credit ratings. So that's for for private borrowers. But you can also calculate the credit worthiness of institutional borrowers. Could you give me some example of an institutional borrower? Some institutions that borrow money on credit markets, financial markets. Are governments institutional borrowers? Yeah, governments, corporations. Corporations issue bonds, stocks. Governments issue government bonds. The example that I mentioned, Germany versus Greece. Bonds, a large part of financial markets, the bond market. So what is a bond? That's an IOU. I'm going to pay $1,000 in a period of time. 1 month, 3 months, 6 months, 1 year, 20 years. There are long-term bonds and short-term bonds. What is the interest rate? The interest rate is an implied rate of discounting this bond. Essentially, you pay cash in the present for a promise to get back more money into the future. So you pay the present value. The bond's future value is $1,000, and then depending on the interest rate, you pay the present value. You pay the amount of cash in the present to purchase a right to get paid $1,000 after a certain period of time. So if the interest rate is higher, then the present value will be lower, or vice versa. So we know that already from last week. The present value and interest rate are inversely correlated. Higher the interest rate, lower the present value, and vice versa. The lower interest rate, more will be paid right now. More valuable the investment is. Okay, so who does the equivalent of this private credit rating in the corporate world and the government borrowing? Are there institutions that are specialized in this? Anyone?
Central bank? Central bank?
No. Central bank kind of indirectly regulates these institutions, but it's not the central bank that does this credit rating. It makes sense. You would have expected that to be the case, having in mind that the central bank does monetary policy and supervises financial markets in so many ways. Yet, no. Here there are other separate agencies. Agencies that are called the credit rating agencies. That are certified by the federal government. There are three of them that are most important. Standard & Poor's, Moody, and Finch. These two are the three most important ones. And they form their one Standard & Poor's, Moody, M-O-O-D-I, and Finch, I think it's F-I-N-C-H. These three credit rating agencies are one of the few successful cartels in American economy. And they're successful because the government prevents other agencies from entering the business. They are officially certified credit rating agencies. So what do? They simply rate government and corporate bonds based on how risky they are. They evaluate the risk of certain government, all government and private corporate bonds. And they have an entire nomenclature, the entire grading system, just like the school grades, from A to D. And anyone knows what is the best possible grade for investment, the most secure investment, the most secure bond with
AA or AAA?
AAA. Yeah, that's AAA. And then you have, depending on the agency, you have slight variations in these notations, A plus, and so on, A minus. Essentially, like a rule of thumb, all A graded bonds are very good. In principle, that means that they're secured, there is very low risk of default. And for A minus bonds, you can say that they slightly depend on the macroeconomic policy and inflation and so on. But for the most part, A bonds are the best. Then you have a B. You put B and then down the line. These are relatively less secure. There are a variety of subversions of B, and eventually C. From C down, that's called junk bonds. These are highly speculative investments, very risky, which usually involve very high interest rates. Involve high interest rates, that means, what does that mean? For you as an investor, as a company that issues junk bonds. Present value is very low, which means you can get very low amount of money right now from investors, and you promise to pay a high amount of money in the future. So junk bonds have a very low present value. The AAA and all high A graded bonds have a very high present value because they're estimated to be very low risk, which means that their implied interest rate is low, which means that the present value is very high. So then if you want to have a secure investment, you have to pay for it. You have to accept a lower rate of return. This is what it says. So that looks on the paper very, very nice. So you have these three reputable firms that rank and evaluate the riskiness of different investment, and then individual investors, small and large, can be secure that they have a pretty good handle of how risky their portfolio is, how risky the bonds that they buy are. In theory, that should be the case. However, that's not always the case. Whenever you have a cartel of firms that do certain business and nobody else is allowed in, you can guess that problems may occur. And here, the clearest example of a problem occurring was before the 2008 financial crisis. So you know what was the main precipitating event for the financial crisis? What went wrong in 2006? Housing market went down. So what was the problem with the housing market?
They were rated as AAA, but
yes, so you know, everybody was investing like crazy in 2000s in real estate in America. And the reasons for that were very curious. Because in every recession, in America and worldwide, forever, in the last 200, 300 years, every recession, the real estate prices would go down. And would go down significantly, much more than the prices of other commodities and assets. So you know that they will increase significantly more. We will see in a moment why is that the case, why real estate investment belongs to the class of investment projects that typically are, during the boom, inflated more than the average, and then why they slump much more than the average of the economy. And 2001 recession was the first. So after 9/11, you know, that there was a very mild brief recession for a few months, and real estate didn't come down. The stock market went down, and the prices of all long-term assets had gone down, but real estate for some reason didn't. And everybody concluded that this meant that real estate is the safest and the most promising investment in the world. And everybody and their cousins started buying the new houses and going into debt and taking mortgages for houses and so on. And very quickly, investment banks discovered new ways of increasing investment in real estate through something called mortgage-backed securities. So you know what is that? Anyone heard about that? Mortgage-backed.
So if you default, they'll pay it or something?
So I have a loan in your bank. That's an asset on your balance sheet. He has a loan in your bank. That's an asset in your balance sheet. A couple of them have this. Then an investment banker comes along and say, would you sell me that? Would you sell me all of those loans? You sell the loans. Now I have the loans. They're transmitted from your balance sheet to mine. Now I'm an investment banker. What I do now, I collapse together multiple loans that you have into one mortgage-backed security. I can transform them into bonds and sell them on the market. I have 5 loans into one single mortgage-backed security. One of them is from a very good borrower. Another one is from a kind of mediocre, and one is from a subprime borrower. And then we believe that all of these loans are secure because real estate never goes down. Real estate is super secure. So the lending criteria in the housing industry went down dramatically in early 2000s. That means that people with no credit history, people with no jobs, people with no income, with no assets, were getting mortgage loans for houses. There was this story about ninja loans. Anyone knows what's that? No income, no job, no asset loans. You still get a loan. The prices of housing stock were increasing, so people were flipping houses. You borrow money, buy one, you pay it back. The price increases, you sell it, you buy another one, and so on. Investment banks are gambling hugely into buying those loans, both good loans and subprime loans by those people who have a very bad credit rating, counting that nothing can go wrong because the prices are increasing. As long as the prices of real estate go up, nothing can go wrong. You bundle together a bunch of different loans into a single mortgage-backed security, you sell it on the market, everybody's buying because the prices are going up. Nobody is going to default on a loan. Because real estate is secure. Why is real estate secure? Because Alan Greenspan told us, chairman of the Federal Reserve. Last time we had a recession, buy real estate. There was a huge propaganda about buying houses. Both Republicans and Democrats are spreading this, and the central bank to boot. What Moody and Finch and Standard & Poor's did, they gave to all those mortgage-backed securities that are filled with subprime loans, that are filled with the loans that would usually be treated as junk bonds, essentially, junk level, CD level of investment. People, I'm buying a house and taking a mortgage, I've got no job, I've got no assets, I've got no income. Or I don't satisfy nearly enough the standard criteria that the bankers and other savings and loans industries would require for. And all of these loans are transmitted into financial markets through mortgage-backed securities. So what these credit rating agencies do, they give AAA to mortgage-backed securities across the board, saying, buy this, spend your bottom dollar to this. This is super secure, just like a German government bond. Nothing can go wrong. And what went wrong eventually when the prices started going down, the subprime mortgage market collapsed, essentially. People started defaulting en masse, and the entire segment of this market went downhill. So this was the precipitating effect, the precipitating event in the financial market collapse in 2008, this overinflated real estate market. It's mania, like a tulip mania. Have you heard about that? In the 17th century, that everybody was buying tulips in the Netherlands. That's the first attested case of business cycle or a recession or speculative bubble. That people were spending their last, what is the Dutch currency? Guilder. The last guilder on their life savings on tulips. And eventually when the bubble burst, the price went down, people lost almost all savings. So something similar in 1990s, it was NASDAQ. It was the software industry in America. and it collapsed in the late 1990s. Fortunately, the rest of the economy was not affected. It was kind of isolated financial bubble. In early 2000s, it was the housing market, and this one was really big, and it couldn't be contained eventually. It affected the entire economy. So the banking system, the banks, and other financial institutions that were heavily leveraged, they were underwater. Many of them had to be bailed out. Some of them went bankrupt. Lehman Brothers went bankrupt. Bank of America and many others were bailed out by the Republican administration of George W. Bush in September 2008, early October 2008, to the tune of $800 billion. And all of that began in 2006, late 2006, when the prices of real estate started going down and this financial bubble started. And you can say now with almost perfect certainty that one of the main reasons for the financial crisis and the sharp recession in 2008 was this misperception of risk, the underestimation or underestimate of the level of riskiness of certain securities, certain forms of investment. And those credit rating agencies played a very sinister role in luring people into buying a huge amount of investment or investing huge amount of money into securities that were much riskier than they told them they should be if they are. So this misperception of risk played a key role. So you see how important this task is. And later on, now we know better, and people are not 100% confident in the credit rating agencies. Estimates we have now alternative mechanisms, and people are more cautious when it comes to these corporate bonds. Okay, one more thing now. So that's real interest rate involves risk plus time preference. But there is one more complication here. That the interest rate investors will pay on the market involves another component, which is inflation. And inflation affects the market interest rate in the exact same way that the remaining two components do, by augmenting, by confounding. So nominal rate is the interest rate that we actually pay on the market. And it is calculated by the real, as a sum of real interest rate. This is the one that involves both time preference component and the risk component, plus inflation rate. So let's say this is the present money, $1,000. Time preference component is $50, $35 risk component, and let's say that inflation is expected to be 2%. So what is then the future amount of money that you will have to pay in exchange for $1,000 in the present? Can you tell? 2% interest, annual interest rate.
What was the question? How much?
The question is how much money you will have to pay in exchange for a loan of $1,000 if the time preference component is $50, the risk component $35, and the inflation rate is 2% per year. 1,105. Why is that? Yeah, 20. Yeah. 20, that's 2%. So then 1,105. So see, then the nominal interest rate would be what? 10.5%. the nominal interest rate. So it includes both the time preference component, risk component, its default risk, cost of negotiation, and so on, plus inflation, expected inflation. And this is tricky. This is why things are kind of complicated here. You don't know what is inflation going to be in 1 year. Nobody knows exactly. So the nominal interest rate involves time preference risk plus anticipated inflation rate. Anticipated or expected. Now, what if it turns out that we expected too much inflation? Or let's say, that we expected too little, that the realized inflation rate was higher than the expected one. Who is going to suffer? Creditor or borrower?
Creditor.
Why?
They should have got more money. So they should have.
Yeah. So if inflation rate is higher, then the nominal rate will be higher than the real rate. So then the future amount of money. Here, this is the future. This is P. This is F. 1,105. That's the future amount of money that you have to pay if the inflation rate were 2%. If it were 3%, what is then the amount of money you need to pay? It's 1,115. The fact that you paid this lower sum favors you as the borrower. So you're paying back the money in dollars of lower purchasing power when inflation is higher, which means that you're better off. That inflation higher than expected inflation, higher than anticipated inflation will favor borrowers. Vice versa, if you have lower than expected inflation, then the creditors are favored because money will be paid back in the currency of higher purchasing power. So let's say that that expected inflation were 3%, then the expected future amount of money was 1,115, and then inflation rate were lower. So then you're going to get your money in the dollars of higher purchasing power. So you see nominal interest rate always greater than real interest rate if inflation is positive. So creditors favored when inflation is lower than expected. Borrowers favored when inflation is higher than expected. If inflation is anticipated, then nobody is favored. So it doesn't matter whether you have a zero inflation rate or you have 55% inflation rate. As long as you can correctly predict or anticipate the inflation rate, neither creditors nor borrowers are favored. Now the problem is that higher the inflation rate, lower predictability of the rate will be. That's the problem. So you need a low inflation rate not only because you don't want to have higher inflation, but you need a low inflation rate because the departure of the realized inflation rate from the expected inflation rate will be lower. That means better predictability, higher predictability is good for business. If people know that there will be 2% inflation rate plus minus 0.12, people will be feeling very good, both creditors and borrowers, about extending credits loans. Higher variability, lower predictability of inflation rate means higher variation in expected interest rate, then people will be more cautious to extend the loans. So in principle, actually, in practical terms, you would like to have very low inflation rate and a very low difference between nominal and real interest rates. When nominal and real interest rates are exactly equal, what needs to happen for that?
Zero.
Yeah, zero. If you have deflation, then the real interest rate is higher than the nominal interest rate. Who is favored with deflation? Creditors or borrowers?
Creditor.
Yeah, creditors. So in principle, borrowers like inflation, creditors like deflation. That's another kind of rule of thumb. Okay, so nominal real interest rates, and then the structure of the real interest rates. These are some of the key components of this story. Okay, 7 or 8 minutes. One more thing that I talked about already, but I will remind you just. What happens, how different types of investment are affected by a change in interest rate. I mentioned before that the real estate is one of those industries in which are highly sensitive to the variation in interest rates. Small change up or down will affect greatly investment in real estate. Cars, buildings, real estate, long-term processes like mining, manufacturing required for mining, and so on. All of these processes are, all of these investments are highly sensitive to the interest rate. Why is that the case? What do you think? Whereas short-term business projects are far less sensitive. The present value is how much you want to invest now for a certain future yield. It's calculated like this. So now, you know the general formula here is for a longer time period, where t is a given time period, then longer the time period, greater the discounting factor, and lower the present value will be. So let's say that we have a present value for 1 year, $1,000, future value, and interest rate is 4%. 5%, let's say. So calculate with present value. 1,000 divided by anyone having the calculator. What is the present value?
$952.38.
Okay, $952. Let's now calculate for a 5-year investment at the same interest rate. Present value, $5. Oh, 5 years for the same interest rate. So then 1.05 to the power of 5. Fifth power. So can you calculate with that? It should be lower, of course. $784. Okay, so you see the present value of a yield in 5 years is significantly lower than the present value of the same money in 1 year, as expected, of course. Because you have to wait 5 years here, you have to wait 1 year here. Okay, let's now switch the interest rate. Let's now do the calculation if interest rate is not 5%, but 3%. Let's do first the calculation for 1 year. $971. So it increased somewhat. What is this? Maybe whatever it is, 5%. Let's calculate 5-year present value.
862.
862. So what changed? What can you tell me by looking at the numbers here? Interest rate dropped from 5% to 3%. How the attractiveness of the 1-year project versus 5-year projects changed? The relative prices of the two projects, how they changed? $682. Are you sure?
862.
862. It's impossible. It has to be higher. Okay. What can you tell me?
You gotta pay more for it because there's less risk.
Yeah, this one increased by 20 percentage points, but maybe 5%. By how much? 5-year present value of a 5-year project increased. Way more, like a 20%. Whatever it was, you can calculate. 952 to 972, and here from 78.4 to 862. So you see, when an interest rate decreases, the present value of short-term business projects increases a little bit. So which means that the investment in short-term business projects will increase slightly. Whereas the longer the time period, this increase will be higher and higher. For 10-year projects, it will be even more so than for 5-year projects. So the conclusion that we can draw from this is that the drop in interest rates, or the variation in interest rates, affects highly disproportionately the business projects of long duration. 1-month loans or 3-month loans or 3-month projects will be very little affected by a change of annual interest rate going from 5 to 3%. But 10-year projects, hugely. And this is the key, or a key for understanding the problem of recession or a business cycle. Because if you assume I talked about this last time, you can now see it clearly. That a drop in interest rate, which is engineered by credit expansion by a central bank, will lead to a dramatic increase in investment in long-term business projects that eventually could not be fulfilled, could not be carried out, could not be completed. If the interest rate is really, if the change in interest rate is real, in terms that people want to save more money, there is more capital available for.
The change is what? The change in interest is what it is.
The change in interest leads to speculative investment in long-term business projects, much more than it is possible to complete if the central bank creates credit. Now, that's a long story why, but in general, you should just assume that if real savings exist, interest rates should go down if people save more money. If there are real savings, people will then reduce consumption. People will reduce spending on short-term business projects, 1 month, 3 months, 6 months, and invest more into the future. However, when the central bank increases by printing money, increases the volume of credit, people don't reduce consumption or investment in short-term business projects, while increasing investment in the long-term business projects. And there will be no enough resources, labor and capital to finish all of these business projects. We'll continue. We'll go back to this business cycle. I'm just hinting at it here and there. For now, just remember that these long-term business projects are disproportionately affected by the change in interest rate.